Okay, welcome to the January 16th edition of the Fats, Fuels, and Oils webinar. Today's going to be a little bit different. Typically, we don't have webinars on Tuesdays after holiday weekends because what happens is you come back Tuesday, everybody's busy in the morning, and then you don't get a presentation together like I did not today. So today is going to be a little bit different than what we normally do. The good news is it'll be shorter. The bad news is you'll just have to listen to me sort of ramble on about what I think's going on right now, and then I'll get you out of here and we'll be back to our normal schedule. A couple other housekeeping issues. One is that the cable company is out working on the cable in my area, and so they sent me an email that said I might lose internet connectivity today. And so if I suddenly drop out, unfortunately, that'll probably be the end of the webinar. So if I drop out, it's not, nothing happened. I just lost my internet. The other thing is that when we had the first webinar of this year, this will be a little bit more than you want to know. It was the last in the series that we had scheduled, and so I quickly tried to reschedule webinars going forward because I was worried that if I started that webinar before I added new ones, that it would end the series, and that might mess up all the registrations and all of that stuff. So I very quickly added it while I was trying to start the webinar. I very quickly added a bunch of new webinars to the schedule as I was trying to start that. I have heard since that that Zoom didn't send the usual email, and there wasn't a reminder on people's calendars. So I've changed that. I hope that everybody got an email around noon today that had a link in it, that it all appeared on your calendars. If not, please let me know, because I will reach out to Zoom and get that fixed so that that doesn't occur anymore. The other thing that might have happened is, at least one person told me this last week, or well, I guess it was last week. The Zoom email set up a webinar for 3 p.m. and then switched it to 1 sort of semi-automatically. So if it's not scheduled at the right time, would you also let me know that? Okay, so in the markets, of course, we had a bunch of data on Friday, and we'll talk a little bit about that. The NOPA crush report just came out. We'll talk a little bit about that. But where we'll start is with Brazilian weather or South American weather, and the South American crop prospects. One thing I'll show you really quickly is, if you look at the radar, or at least my radar, I'm starting to suspect that there might be an issue with this. That storm is back over RGDS, and it looks like it's bringing heavy rainfall. As somebody that just got 8 inches of rainfall yesterday, I can feel for the people in Uruguay and Rio Grande do Sul. Too much rain is definitely not a good thing, and especially when you are trying to grow crops. Outside of that, I think the market seems to be sort of split between what's going on in Argentina and what's going on in Brazil, and really more central or northern Brazil than southern Brazil, where obviously it's way too wet. And so the expectations for the Argentine crop are roughly 50 million bushels, give or take a million tons or so. And that seems, there doesn't really seem to be a lot of disagreement. Sorry, I'm going away real quick. Doesn't seem to be a lot of disagreement about that, and the weather generally supports it. However, if you look at the cumulative rainfall chart that we show sometimes for Argentina and Brazil, the two lines on there, or the line in the area, essentially the line represents normal rainfall, and then the area below the line or around the line represents cumulative rainfall over some period. And so for both Argentina and Brazil, for the last 2 months or so, if you look at the weather pattern, it looks very similar, with sort of some timely rainfall that kept the area part, the realized rainfall, moving up sort of at the same slope or very close to the same slope of the normal rainfall line, which means that the season started dry, and then there was enough rainfall to kind of provide normal soil moisture levels. Now, there are a couple of things, particularly in northern Brazil, where it was hot early in the season as well. And when the ground is dry, then that rainfall, especially if it's not 8 inches, will not necessarily soak the ground, particularly when it's hot. And so it's not quite exactly the same as saying, oh, conditions were just normal and everything's good. However, there are estimates for Brazilian soybean production that are well below 150 million tons, like 20% below 150 million tons. And so, or maybe not quite that much, but there are some really low estimates out there. And while the last 3 years, I think it primed a lot of people to expect that South American yields will be significantly impacted by the growing conditions this season, I tend to think that most things end up sort of in the normal range, unless you have something like the drought in Argentina last summer, and it becomes really, really obvious, or unless you have a La Nina. Now, we have an El Nino, and El Nino has an impact on northern Brazilian yields, and there's a lot of planted area in central and in northern Brazil. So it doesn't take much of a yield reduction from trend line to cut into expectations for Brazilian production. That said, João and I went through state by state last week, or really João went through state by state last week, and then I looked at it after he was finished, and estimated the yields for each state based on weather conditions so far this year. And we got down to 157. So that was in line with where USDA ended up, I believe. And sorry, I was trying to pull up the WASDA report. I hate not having a presentation. And they also, really sorry about this. They also raised Argentinian production. So USDA, and some of you already know this, so I apologize. USDA cut the Brazilian crop from 161 to 157, in line with ours. USDA's estimates for Brazilian production tend to be slower coming down than market expectations, I think. And so it doesn't necessarily feel great to be where USDA is now. However, it does also, there's a long period before these last 3 years that would suggest that South American yields could be better than current market expectations. And so if we get a 50 million ton crop out of Argentina, and the Brazilian crop is not 150 million tons or lower, which is kind of, I think there's a lot of people that's kind of about where they are. They're between sort of 150 and 155 probably. And so if we get a 150 or a 155 crop out of Brazil, that still is Brazil's essentially equal to at 155 or a little below last year's production. At 150, you lose maybe 6 million tons from last year to this year in Brazil. but you get basically 25 million tons increase year-over-year increase out of Argentina. So as long as the Argentinian weather pattern continues to hold, and remember, Argentina is well behind where Brazil is in terms of crop progress. Brazil is harvesting some of the crop already. Argentina is still planting. There are some soybeans that are planted relatively early in Argentina that are probably much closer to being finished, but I don't think any of them are really, really close. And so weather conditions in Argentina will matter more than they will in northern Brazil or even central Brazil, where in central Brazil, harvest is going to start in the next couple of weeks. And so at that point, really the yields are set, and whether it's hot and wet or cold and dry in Brazil will probably have less of an impact on yields than whatever the weather is in Argentina going forward. So I say all that to say that even if you assume that Brazilian production is 150, you should think, I guess, that the Argentine crop is going to be close to trendline yield expectations, wherever your trend line is, whether it's 45 or 50, it's going to be somewhere in there. So we're going to lose 6 million tons out of Brazil from last year, but we're going to gain 25 million in Argentina. That is 19 million tons, which if you are outside of the US will be a familiar number to you. But if you're inside the US like me, helps to convert it to bushels, just under 700 million bushels of additional supply out of South America. That's about 20%, a little bit less than probably of the of US production. So it seems likely that as the Brazilian crop continues to develop, and if the weather forecast holds, the weather forecast and the weather data from the last several weeks have shown consistent, modest rainfall nearly every day in parts of central Brazil. And the forecast calls for the same, although the rain trails off at the end of the forecast period. If that trend continues to hold, then I would argue that that the crops in Brazil that aren't already through pod filling and through leaf dropping and ready to be harvested probably would improve a little bit, and it will become tougher and tougher, at least in my mind, to kind of really take predictions of a crop that's 150 or below seriously. Now, Joao is actually in Mato Grosso now and will be in Mato Grosso for a little while. So he's going to have a front row seat. And over the next week or two, after he's gotten some real good color on what the harvest looks like, on what yields look like relative to last year, then I'll have him do a presentation on our webinar, probably maybe the second week in February, and have him kind of talk about what he's seen and what he really expects for the Brazilian crop. The fundamentals in soybean, outside of that, let me just sort of wrap up the rest of the soybean commentary. Outside of the USDA report, USDA also issued their annual crop production summary report, which is where they make sort of their final, although it's really the next to the last estimate of US production. They'll have one more change in the estimate well, I guess at least one more next September when they release that grain stocks report. They also give a final number for production. However, in the WASDE or in the annual production summary, they also go back and can revise prior years. So for 22-23, 2 years ago, USDA took production up by 185 million bushels on a little bit bigger harvested area that offset just a modest decrease in yields. And they offset part of that with a 4 million bushel increase in their residual use. And that left ending stocks, which they also reported on Friday or revised on Friday, at 264 million bushels, down 4 million from their previous estimate. For last year's crop, they raised U.S. soybean production by 35 million bushels, despite a 435,000 acre reduction in harvested area that increased the yield by 0.7 of a bushel to 50.6 bushels per acre. At 50.6, given the growing conditions that the U.S. had last summer, where they weren't horrible, they weren't great. But if we're going to make a 50 bushel an acre crop out of those conditions, if you remember, it started really dry. Planting really after a little delay moved forward really quickly, and then it was dry at the beginning, and then we got sort of timely rainfall generally through the growing season, but not as much as I think farmers would have liked. But that made a 50.6 bushel an acre crop. And so that change is part of the reason that I argue that Brazil's crop could be bigger, because I think, and I know I've told the story a lot of times on this webinar. There were several years ago, I talked to some seed companies, and they were just apoplectic about the improvements in seed technology that were coming within the next 5 years. And it seems like part of last year's Brazilian crop, that crop in Mato Grosso that was just huge, and the US crop would both suggest that the seed technology is helping some with drought tolerance or yields when you get less rainfall than you would like. And typically the way that those work is they improve the root system, either make it more robust, more pest resistant, or just go down deeper into the soil. And given that that is probably the genetic modification that has resulted in a 50.6 bushel crop in the US last year, drought is kind of the one weather phenomenon year to year that can really have a significant impact on production, like it did in Argentina last year. And so if the seed companies are reducing the impact of drought, now if it doesn't rain, it doesn't rain. It's not like they're ever going to get to a crop that doesn't grow without water. But to the extent that they can improve that performance in drier than normal conditions, you just take some of the variability for expectations of production in the coming years out of the equation. And while the market certainly price futures contracts on the current supply and demand, every analyst and every trader are going to look at that 50.6 number and think, well, it seems likely that even if Brazil is 145 this year, if we get a good crop in the US next year and then another good South American crop after that, it still remains extraordinarily hard for me to see how soybeans wouldn't have at least the potential to drop down into the single digits. Now, it may be that we are past the time that soybeans can trade under 10. If you look at corn prices, wheat prices, or soybean prices from 2000 or 2001, 2002, soybeans essentially traded at $5, corn traded at $2, and wheat at $3. And if we got a 10-cent move in soybeans, that was kind of an exciting day. After the initial ethanol boom and the the participation in the commodity markets by larger institutions, hedge funds, insurance companies, pension funds, those kinds of investors now have more allocated to commodities as an inflation hedge than they did in, say, the late 90s. But soybeans don't trade at $5 anymore. Maybe we'll find out. Maybe the US will grow a 6 billion bushel crop next year, and Brazil will grow 175 million ton crop, and Argentina will grow a 75 million ton crop. And then maybe soybeans would trade down to 5, although I kind of doubt it. It might be that 10 is sort of the new 5, where the fundamentals of the world market have changed so much because of the increased use for the increased demand for vegetable oil for biofuel, that my idea that the next couple of years are probably going to look a lot more like sort of 2015, 16, 17 than they did the last 3 years, where prices had been really high because of a drought in 2012, and then they kind of moved back down to the lows that they hit during the Great Recession of 2008, but didn't move down below those. They didn't go back to 5 and start trading at 5 again. They bounced off those lows, and then they went up, and then we had weather problems and the increased demand, and then they went way up. So I say all that because I think that there's a chance, and potentially a good chance, that next year at this time, soybeans are either in the single digits or well on their way to the single digits. But it might be that that the demand is strong enough that $10 just isn't where soybeans trade anymore. Below $10 isn't really where soybeans trade anymore. I don't think that that's true, but I do think that we're gonna find out in the next year or two. For sure, because again, even if Brazil's crop this year is at whatever low number you want to pick, unless we get a return of the La Nina or the El Nino intensifies and lingers through next summer and into next winter, then I think that weather conditions in South America probably will be supportive, and you will get another big increase in Brazilian production. So that's going to make it difficult for vegetable oil prices, feedstock prices to rally, because soybeans have a 80% correlation with soybean oil prices. And a lot of that's because soybeans impact the supply of soybean oil. But even when the demand for soybean oil is so as strong as it is now, as you get soybean prices moving lower, it will naturally drag soybean oil down with it. Now, there are some things that should help support soybean oil prices. So if the demand from soybean meal shrinks in the way that it looks like it's going to, now this will be the second time I've gone through this, and the last time the decline in domestic soy meal usage lasted about a month or two, and then it was right back to record. So I say all of this with a big caveat, which is soybean meal demand has been impressively strong over the past year. The decrease in prices from $500 a ton down into the 3 something or 4 something, lower 4s or high 3s, will spark some demand, some increase in demand. But I don't know that you're going to get the same increase or the same robust demand next year that you get this year, at least in the US, because one, the poultry producers will have rebuilt the poultry flock after the very severe bird flu outbreak in the US last winter before last. And it seems like hog numbers are coming back a little bit, and so that's a big chunk of meal consumption. Cattle cycle is still where it is, and that's going to be the case for a little while. Cattle don't eat that much meal anyway, and so meal demand could be a little bit stronger. However, I think that much in the same way that soybean oil topped out at 90 and then kind of moved lower, despite the fact that if you look at the fundamentals when soybean oil was at 90 and you look at the fundamentals today, and you didn't know when it traded at 90, most people would have guessed today just based on those fundamental numbers. I think soybean meal might have gone through the same thing where it peaked just above 500 and now it's working its way lower. And given what's going on in US crush right now, NOPA reported a record 195 million bushels, I think is what it said. US soy crush 195.3 for NOPA. That is just absolutely huge and probably bigger than our expectations, which were our expectations were for the US crush 207. So it might be that 207, which is, sorry. Our expectation for NOPA is a number that does not look right to me. Oh no, sorry. Our expectations were 194.06. So we were a million or so bushels below where NOPA came in, 1.3 million below where NOPA came in. Record crushing volumes will help satisfy the meal demand. If anything, it really looks like between the recovery in Argentinian production, the ample Brazilian supplies, and the biomass-based diesel demand from US renewable diesel producers, or biomass-based diesel feedstock demand from renewable diesel producers, suggest that crushing volumes probably will be record large, not only in the US, but potentially in Argentina and Brazil as well, if the export demand is there. And it's that export part that is going to continue to pressure soybean meal prices, because the big buyers of soybean meal like Egypt and Vietnam, they've slowed down a little bit. And since commodities are priced at the margin, the export demand will be the marginal demand, and that will tend to set the price for the rest of the market. There's basis in the domestic market, and so the cash prices can be different. But I think in terms of sort of a world soybean meal price, it seems really likely that that is going to come down. And that's important, because if we peaked above 500 and now we're just going to come down, then it's very unlikely that the specs will hop back on the short oil share trade. If anything, I would be really surprised if you didn't see a slow but big shift from short oil share to long oil share, probably more along after the second quarter or during the second quarter of 2024, and then beyond the year after that, because soybean meal probably doesn't go up. And it does look like, even though I think the world vegetable oil supply in the first half of the year, and in particular in the first quarter of the year, it looks like we have ample vegetable oil supplies, and I think you could even probably call them burdensome world vegetable oil supplies in the first quarter. In the second quarter, then they start to tighten up a little bit, in part because while palm oil production will emerge from its seasonal decline in February or March, and then start its seasonal increase until September, October, November, the impact of El Nino on South Asian rainfall totals is one of the best correlations for that pattern. And so it already has turned drier in Malaysia and Indonesia. That's likely to continue. It takes about 6 months for today's weather to impact palm oil production. And so that kind of lines up with the second half of the year. Even though palm oil climbs out of its seasonal decline, the impact of El Nino keeps that increase a little bit smaller than it would be in typical years. So in the third and fourth quarters of 2024, it seems much more likely that that vegetable oil prices will rise than soybean meal prices. And because of that, I think unless you are just a hedge fund that takes the opposite side of the conventional wisdom bet all the time, and there certainly are contrarian traders like that, you probably are not going back into the short oil share pool anytime soon. And so even though it has gotten the anticipation of growing U.S. imports of tallow and UCO have made it easier to kind of solve the balance sheets. It does seem like there's a good chance that world vegetable oil supplies will tighten up a bit in the second half of the year, in part because we'll be past the South American crop, and that's going to turn into mostly the export serving crop. And then we'll get to the U.S. crop, and that will increasingly become a domestically used crop. That said, like I talked about when we talked about UCO last week, it looks like significant growth in UCO helps drive a lot of what I just talked about and makes the balance sheet, balancing the balance sheet much easier. I was really relieved to see the November trade data because UCO imports into the US dropped by about half, including a cut in Chinese supplies by about half. And so if it had been 400 million pounds again, or nearly 500 million pounds again, I really probably would have had to try to figure out what to do with the additional kind of 2 billion pounds of UCO that I needed to add to our import prediction. However, with the 200 million pound November total or whatever it was, I've seen the number shortly in passing, and I remember it was significantly smaller, but I haven't really put it in and looked at it yet. That gave me enough room so that I don't have to change that. And it also makes it look like probably I think we're at 3.8 billion pounds of imports this year, seem reasonable right now, not too big or too small. And that will help relieve some of the pressure on US domestic feedstock demand, and will probably keep basis levels in the US from screaming higher. However, basis is another area where it has been amazingly weak despite the increasingly bearish fundamentals. And while it's difficult to make an argument based on the fundamentals that basis will come back, it does seem like this is a bit of sort of almost the calm before the storm. Now, we've already had the storm, so the last couple of years basically were the storm, so it's not quite that, but maybe a lull between two thunderstorms that are passing in the summer. I don't know, that went a little too far with that one. Either way, what it ultimately suggest is that the movement in prices right now isn't necessarily fundamentally related. It's much more positioning related and just the market coming back from a significant demand shock. And so prices will get down to sort of wherever the new equilibrium is, especially if the longer term outlook is that we are going to have enough vegetable oil and fats and greases to provide all of the feedstock that the US needs, all of the feedstock that Europe needs, all of the feedstock that South America needs, and all of the feedstock that Southeast Asia and to a lesser extent the rest of Asia needs. So it does seem like the last 2 years were an extreme, particularly when you compare prices with fundamentals. But this break here is probably the break before we get to the new equilibrium, and then the demand probably will demand and stocks and the rest of the fundamental numbers probably will start to have an impact on U.S. basis initially, certainly, and then depending on what the U.S. crop looks like and what the expectations are for next year's South American crop, then that will be sort of that crop cycle will be kind of the final, excuse me, the final sealant on this whole move in vegetable oil prices because of the growth in U.S. renewable diesel demand. For this time, as we ramp up SAF, I think this probably will all come back. We probably will go through basically about the same exercise in 7 years, maybe, as tightening U.S. crushing capacity and vegetable oil refining capacity start to raise basis and prices again, unless we really have the crushers kind of out in front of the growth in demand related to SAF and expand capacity in anticipation of that growth. I don't think they will. I also don't think I would if I were a crusher. I think I would probably wait to make sure that the demand actually was going to be there before I made a significant capital investment. So I think we're going to go through this cycle again, and I think that and this might be off by years, but I think that right now and for the first quarter for sure, and maybe at least the beginning of the second quarter, or maybe it's a little bit longer than that into the second quarter, you probably have weakness or steadiness in biomass-based diesel feedstock prices and more broadly fat and grease in vegetable oil prices. But then I think they start to slowly move back higher. I don't think that while I think volatility probably remains elevated, I don't necessarily think that the next move up will spark a bunch of volatility or be driven by a bunch of volatility unless there's a weather problem. If there's a weather problem, then of course almost anything can happen. All right, the final little bit that I'll sort of drone on about, and then it looked like there was a question, and I will answer that or any others that you have, and then let everybody get out of here. Still can't do 30. The main reason that we're going to go from sort of ample world vegetable oil supplies in the first quarter to less ample in the second, and then potentially short in the third and fourth, is because of the production of sun oil and rapeseed oil. I think sun oil is probably the more critical to this argument than rapeseed oil, but I think they both are probably kind of similar in terms of when their big supply comes and when that sort of wanes a bit. And obviously, in the Northern Hemisphere, we are done with harvest and we're in kind of the heart of the seasonal pattern in crush, or we typically crush the highest volumes of soybeans or canola in the US at this time. And that's generally true for other countries as well. And so Ukraine and Russia are the world's leading sunflower oil suppliers. And their crops have had, I'm sure, difficulty, particularly well, exclusively in Ukraine, problem planting, less acreage to plant on, and then problems getting the crops out of the country. The land route into Europe has started to cause some problems with some of the EU member states. And so Poland at some point, I think, said that they weren't going to take any more Ukrainian sunflower seed. And so there's been a little bit of a reshuffle in the exact trade routes to get Ukrainian sunflower seeds or sunflower oil and meal out of the country to the export market, still those crops are in the production of that oil is kind of what pushes the world over the top. And so as the output for rapeseed, canola oil, and sunflower oil slowed down seasonally, then the supply the world supply is going to tighten, because there isn't really the same seasonality in biofuel feedstock demand that we used to see, where in January and February, you typically got minimal production and minimal feedstock demand, and then it grew all year to December. Now it's just kind of growing steadily, probably at a slower rate this year maybe than we saw last year. That said, our prediction for the expansion in renewable diesel capacity for this year is very similar to the expansion that was realized last year. But that increase last year was a much bigger portion of the total feedstock demand than this year's will be, because of the increase last year. So I don't think that it will cause as many problems. Okay, so that is kind of that. Last thing that I'll say, and then I'll get into the questions. The one area that could potentially still kind of throw a bit of a more bullish tint to the fundamental backdrop is U.S. oil, soybean oil yields. So if you look at the yield in October, it was 11.8 pounds. The October yield is always sort of the last remnants of the old crop beans getting crushed. And so, or at least at that point, they still represent enough of the crushing mix that they are generally setting the yield number. So 11.8 was just below the 11.82 average for 22-23. November's average yield was 11.62. Again, that was similar to last year's, just above it at 11.61 last year. Last year, I had similar concerns, but then the average was 11.8. The primary determinant of oil content in soybean seeds is temperature and rainfall or soil moisture levels while the beans are filling their pods. This year it was a little wetter, but it was also a little, if I remember correctly, it may have been a little warmer than usual at the end of the year as well. And wet and warm is kind of a little bit of a offsetting. Wet usually equals lower oil yields, and warm usually equals higher oil yields. Yeah, I think that's right. Wet. Anyway, the oil yield still could reach last year 11.82. We're predicting 11.83. However, if the 11.62 was an indication of where this year's yield is going to be, and we don't get the increase like we saw last year, then that could reduce production, given our expectation of crush at 2.3 billion pounds. Every 1/10 of a pound reduction in yield is 230 million pounds of production that are not available. So it's a little bit in the weeds, but it can have a really big impact on production. And we're at the time of the year where we don't quite know yet what the yield is going to be going forward. But the drop from October to November, which is not unusual, does make it so that we'll be paying very close attention when they report the December number. And actually, when I get into the NOPA data, after I'm done with this, they will also have a yield estimate that is indicative of where USDA is going to be. NOPA's yields and USDA's match up generally fairly well, or the difference between them is relatively steady. Okay, on to questions, and really appreciate your patience today. We'll be back to normal tomorrow. The first question is fantastic. It is asking if I'm presenting because they're not seeing any slides. And while if you're new to this webinar, that would be an odd question for most, since I have actually presented two whole webinars thinking I was showing slides and wasn't. That's a very reasonable question. And unfortunately, we don't have slides today because a lot of stuff that you don't want to hear about. I see you are forecasting BFT to recover from 50 to 60 cents a pound mid-year and then back down to 50 by December. So part of where I'm probably struggling the most right now is with the outlook for fat and grease prices. Typically, I think if you just sort of lag your soybean oil forecast by 4 to 6 weeks and then repeat it for the fats and greases, that's probably not a bad way to go about predicting prices. However, because we had some odd changes, we had some extreme relationships between soybean oil and some of the other feedstock commodities last year, or the last couple of years, certainly. We have taken a little bit different tack in the way that we predict fat and grease prices. So I would say part of it is probably a little bit of growing pains with the model, and I'll go back and look at that. However, if the bullish argument for fat and grease prices, I think, goes like this, which is currently we are close to using up the domestically available supply of fats and greases, or I guess I should say we have used up the domestically available supply of fats and greases. That's why we're getting big increases in UCO and tallow imports. If the domestic supply, BFT in particular, continues to shrink, if production continues to shrink because of the turn in the cattle cycle, that should help support prices. And then in the second half of the year, I kind of assume that the growth in UCO is going to pressure all fat and grease prices and probably all feedstock prices, actually, more broadly. Assuming, one, that we do get a substantial increase, and we already do have a substantial increase from last year, but we get another substantial increase this year in our UCO imports. And it looks like that's going to happen based on the Chinese shipping, the Chinese volumes, and the high likelihood that all of these other little countries, not little, I shouldn't, all these other countries that have typically not been exporters to the U.S. have started to ship UCO to the U.S. That means that they've got their domestic logistics all set up, and so there's no reason that those can't continue either. And so it's kind of a I guess to kind of try and make this a little bit easier, better explained. The first half of the year is kind of the old paradigm, which is we're running out of all of this stuff, and that's going to help support prices. And then the second half of the year is where I think the new paradigm is going to be, which is large imports of UCO and tallow start to provide sufficient supplies to the biomass-based diesel feedstock market that you can actually reduce soybean oil usage, at least the portion of the total feedstock mix represented by soybean oil, and then you also meet all of the renewable diesel feedstock demand, and that all then pressures prices in the second half of the year. I think I said it last week, but just in case I didn't, the other thing that the imported UCO and tallow could potentially do, and our balance sheets reflect them, and when we post the reports this week, you'll see it in the well, you won't see it in the U.S. soybean balance sheet. You will when we get to the platform. The U.S. Soybean balance sheet also will. Where's that going with this? The U.S. soybean oil exports, because of the increase in UCO, there's a potential that U.S. soybean oil exports could start to grow again in 24, 25. I really don't think that's going to happen, but right now, based on our numbers in our model, we've increased in exports in 24, 25 and 25, 26, back to like 900 million pounds. Again, I don't think that'll happen, but it kind of speaks to this transition from the old, we're going to run out of everything. How low can I cut exports to, I wonder if exports actually might increase a little bit. The U.S. imported over 13.3 million gallons of biodiesel from Spain in October, marking 2 record-breaking months. Any thoughts on what's driving this significant increase, and how does it compare to previous trends? So in October, we had our initial European biofuel conference, which if you didn't attend, you should. It's a good conference, and who doesn't need an excuse to go to Europe if you live in the US? And during that conference, I had a really interesting conversation with one of the attendees who was European, and he was really upset with the European government, both at the European Union level, and I think probably more so at the individual country level. The European system, I guess sort of the same way the US system, individual countries set their biofuel policy, and then the European Union sets a biofuel policy above those, the same way that we have the RFS and the LCFS. And he was upset because he didn't think that the European Union government went far enough or was strong enough in setting its policies, and that while some European Union states were really pushing biofuel hard, he felt like others were not, and would almost, I don't think he made this argument, but he almost could have, in sort of the direction that he was going, that some of the European Union states some of the European Union state governments would reduce or weaken biofuel policy to the point where he said we might actually export biodiesel to the US. And that actually was pretty prescient. And I think the primary reason for it is that you've gotten a break in feedstock prices now relative to the last couple of years. The European market isn't necessarily as lucrative for that fuel, or at least the Spanish market isn't as lucrative for that fuel as the US market is. And so you get those shipments, and as long as the economics for biomass-based diesel remain similar to where they are now in Europe, then you probably will continue to get exports, maybe not at record-breaking volumes every month, but you probably will either get shipments of biomass-based diesel from Europe, or increased feedstock exports from Europe to the US. And one of those actually is, I did our UCO trade data the other day, and one of the countries that traditionally had not been an exporter of UCO to the US are some European Union countries. It's not that they never have, but because they have their own biofuel program, typically you don't think of Europe exporting UCO to the US. And they have started to do that, which was another thing that guy said. And so it does seem like until or unless there's some changes in European biofuel policy, that there probably is going to be a bit of risk both on the for domestic US producers, potentially a bit of competition from export volumes out of Europe, but you also might be able to find some feedstock out of Europe that may be I guess could potentially be attractively priced relative to US supplies. Less convinced of that, although UCO, I think, is sort of the type O blood. It's like the universal, everybody can ship UCO pretty much to the US. I apparently are on the website, our EMTS data stops at 2021. So that shouldn't be. The data is already updated and has been updated. And I extended it out to, I think, I don't know, 2023 or well, 2024 at the very least, a while ago. So I'll look into that. My guess is that there's something in a link someplace that has gotten a little out of whack. And so the data is there, it's just not showing up on the website. But I'll look at that right now and try and get that sorted out so that works. If you see any other problems with our website, please always let me or let Joao know. We're in the relatively early stages, and maybe some of you have heard about this, and some of you haven't. We're going to shift from our website to a platform. The platform will be a kind of like a Reuters terminal or a Bloomberg terminal, from the perspective that it's kind of a piece of software that, and it's actually, I think, a website, but that you can drag different widgets into that are either predefined or you define. You can look at news stories and price charts and fundamental data. All of that is in progress, and we're getting closer. At some point this year, we're going to switch over to the platform. And then once we get to the platform, we'll be able to start making changes to some of the charts and tables that we include, although we will have a lot more data available on the platform than we do on the Jacobson website. When we put the report online at the Jacobson, we wanted not to overwhelm people with data, and so we limited it. We won't necessarily be doing that on the platform. And so when we do make that switch, if there's something that you want and you don't see, let me know. We probably have it, and I think it will be potentially easy to get it up there. All right. Okay. One last question was just somebody asking me to send them a link. And I don't think I sent the link out for last week's webinar yet. So if you watch it that way, sometimes I'm going to send it out right now. I don't remember sending it out. I might have, but I don't think so. Anyway, it'll be coming. All right. Thank you for all your patience today. I hope everybody has a great week, and we will see you back here much better prepared next Tuesday. Thanks, everybody. Bye-bye.